I'm Ben Narasin from NEA. NEA, for those of you that don't know us, is about a 40-year-old venture firm with $26 billion under management. And prior to joining NEA, I've been there for about 3 years. I was a seed investor for about 10 years. Prior to that, I was an entrepreneur for about 25. I started one of the first e-commerce companies in the world in 93, took it public in 99. A lot of marketplace elements. We were actually a portal. I've been told we invented cost per click. I don't know if that's accurate. Started doing that model in about 94. So I have both invested in a variety of marketplace companies and obviously been pitched by quite a few. And so the topic we're covering is GMV. Does GMV matter? I'd argue that GMV matters a lot less the later stage your company gets. The critical element is, can the GMV convert into something of value? There's a lot of, I had a debate once with one of my other partners about whether GMV was firmly defined. His view was yes, it was, and my view was no, it wasn't. And for a while, we sort of stayed in those two places. And then we heard a pitch where someone told us their GMV was XYZ, let's just call it $100 million. And I said, well, can you give some more detail on what that means? Because you just told me that you don't have any take rate, you don't have any transactions. Well, it's an inferred GMV. Okay, well, what's an inferred GMV? Well, an inferred GMV is that if we look at the number of connections we made as a business between buyers and sellers, and then we infer a certain amount of conversion, and then we infer a certain value of business that's created from that conversion, we can infer a GMV of X dollars. It's like, okay, can you infer how much of that you can harvest for yourself over time? Well, we're not going to be able to monetize that, but we're going to have other models. Now, that's not an unreasonable statement, but it does make it really hard to quantify what that GMV may or may not be worth. So I'm a huge proponent of GMV is an important starting point, but if it doesn't have a place to go, it's very hard to contribute a lot of value to that, except in a few rare cases. One example would be the connections and knowledge, data, and database that you build are so valuable that someone would be interested in buying the company for that data. Now, I would argue that is almost always an acquisition out of more modest size than I would hope people are focusing on. That's not really fair. I hope that they focus on. Let's take a quick step back. Traditional tier one venture looks for outsized opportunities. And the way I define outside opportunities are businesses that have uncapped upside. So I want to believe that any business I fund has the opportunity to be a freestanding public company and continue on in a successful way post-IPO. That means that it has no real limit into how big it can become. Companies that can sell along the way are also quite valuable to a variety of types of people, but it's not the type of business that I'm focused on. You know, a $100 million, $200, $300 million outcome can be phenomenal for founders. It can be phenomenal for early investors. But one of the realities of venture investing is that you have to ultimately return the fund more than one times over before you start to make any real material impact. And so it's very hard to do that if, let's say we have, in NEA's example, it's a $3.7 billion fund. You have a $300 million outcome in your portfolio. You own 20% of it. You make $60 million. You still pretty much owe your LPs $3.64 billion before you get to carry. And since a partner at a traditional firm is only going to do 1 or 2 deals a year, you know, you only have so many shots on goal. So don't take my comment in terms of this as not being great to have that sort of an outcome. It's just that different types of investors need different types of outcomes. So let's go back to GMV and the value there. I had a company I helped raise several rounds with, and in the beginning they had exceptional GMV. A lot of people were coming in, a lot of people were looking for bids on a specific type of wholesale product, and they had a decent balance of both sides of the marketplace, the supply side and the demand side. They were able to raise a Series A from that. And that seems reasonable. It certainly seemed reasonable pre-COVID. It may or may not still be reasonable depending on how big the total market is. It was, however, a lot harder to raise a Series B, as it should be, because they had not figured out how to monetize that business. And it's very easy as an entrepreneur. Like, I was an entrepreneur for 25 years. I think of myself as an entrepreneur more than an investor. It's very easy to get hooked on that GMV growth. You know, getting that curve that looks like that is awesome. But I remember someone pitched me once about how they had grown to 100 million X's, 100 million users. Wow, it's great, it's phenomenal. And then they turned on monetization. Wow, how'd that go? Well, we made $10,000 last month. It's like, huh, why? Well, the 100 million people only wanted the free stuff. They're not really interested in the things we're charging for. Okay, well then maybe there's, it's time for experimentation. But all of this boils down to GMV is the valuable starting point, but you have to have a path and belief for how you're going to ultimately monetize it to create material value. And if you're providing value to both sides, to the buyer and seller in the market, then you're entitled to be compensated for that. It's always fascinating to me how entrepreneurs will be willing to spend 10, 20, 50, $100 million on software, build something out, and still want to give it away. And giving it away in the service of then getting it to convert in a freemium model is absolutely fine. But giving it away just to grow GMV doesn't make a lot of sense to me. I'll make 2 comments, and then hopefully there's a mechanism here for you to ask questions. So I'd love to answer anything you want. Tomorrow I'm doing an AMA actually, because that'll be an easy way for people to ask any question they want. Entrepreneurs tend to wait too long to try to charge, and they tend to charge too little. They underestimate the value. I remember in one case, I said to the entrepreneur, do you think it's fair that your customer gets $82 million, which is how much has been invested to date, of free software and not pay you a penny? You don't think that they would feel it's reasonable to pay you some amount? And they started experimenting with pricing, and they were able to work it through. But I do have memories of companies that were able to raise rounds. They raised a seed round on GMV. They raised a Series A on GMV. They raised a much harder Series B on GMV, but nobody would touch it on the Series C. The later you get, the more you've got to show how you're converting this into revenue. All right, maybe there is a way to funnel some questions in. I asked this because, as I mentioned, I'm new to Hopin, but I don't see any. So I'm going to continue on. We've got another little bit of time. If there's a way, we've got a moderator, then feel free to post them and I'll hopefully get those fed in. So when people are building a marketplace business, the focus on getting supply and demand in equilibrium is usually the first thing that gets challenging. You have real growth on one side is usually the case, and then you have to revert to getting real growth in the other. I always look at it as, the most valuable side is whichever side is the most constrained, whichever side is the hardest to get. In a lot of businesses, getting demand is the hardest, getting the buyer is the hardest. In some rare instances, getting supply is the hardest piece. But you should grow wherever you are the strongest for as long as you possibly can until you start to get out of whack. If you start off and you're growing and growing and growing, and that's fine, but eventually when you get too out of whack, you're going to have to start to bring it back in. And I've noticed that sometimes it's a very simple thing. I'm sure most people will think, well, yeah, duh. But it's easy to get lost in the moment of watching things grow and not be thinking about counterbalancing them, as you've seen so much, because you have to give both sides a bit of happiness. If they don't have that, they're not going to come back. They're not going to be retained. So, I've noticed that you could often get a very large cohort of people on one side of the equation, but they don't have enough to keep them engaged because there wasn't enough on the other side of the equation. So you get them as the first-time visitor, you get them as the first-time player, but you need to get them to transact in some form. You need to get them to keep coming back. And so, people are constantly looking for ways to augment that. And I think that's going to be critical for any marketplace business. You've got to sort of think about what is the thing that both parties value the most. Now, sometimes that's as simple as I need supply or I need demand, in which case, great. If you are providing them with the actual ability to transact, which is usually the instance of a marketplace, then it's entirely reasonable for you to figure out a way to monetize that. So let's switch to sort of, okay, well, if GMV isn't critical, I need to monetize, what are the most realistic ways to do that? Obviously, there's a take rate, and most of the classic, if you sort of go back to sort of the Airbnb model, the take rate is the most common way you're going to monetize a marketplace. But that's not always the case. In the wholesale or industrial marketplace, you may be able to do a cost per lead, or cost per transaction. But cost per lead is actually a pretty effective mechanism for wholesale and industrial businesses because the player on the other side has to close an order that's going to be relatively large. And you may or may not get ability to view what that size of transaction is. But if you've handed off a highly qualified customer, it's entirely reasonable to ask to be compensated for that. In fashionable.com, when I started it, we had to play with quite a few different, remember this was 1993. I mean, the web was just first born, and people were sort of trying to figure out what it meant, and everybody had analogies from billboards to shopping malls. And in fact, the very first model we tried was a shopping mall metaphor where we charged you rent. Rent based on the size of your store, and the size of your store was based on the pages. And that obviously was silly because we want you to have as much depth of content as you possibly can. And so we tried a billboard model and we tried a sponsorship model. Sponsorship model worked for some. Visa was a very big client. But what we finally realized is the way we put it originally when we sort of came up with cost per click in '94 was, we will send you the most qualified potential buyer in the world. We'll put a turnstile in front of your store. When somebody comes into our site, fashionmall.com, they're clearly looking for only one type of thing. Nobody came to fashionmall.com looking for auto parts. Okay, then they chose to go into the men's or women's area. Then they chose to go into the shoes area. So, this is an extremely qualified, high value individual. Once we've delivered them to you, however, it's your job to convert them. And whether you want to convert them by getting a brand impression in front of them or telling them more about yourself or trying to drive business into the physical stores, or you want to sell them online, is up to you. And so that's where we came up with this model of a turnstile, which we ended up calling cost per click. And so we billed you each time somebody went through. What was great about that is it freed up two things. I think both of these are highly relevant in marketplace models today. One, we could do anything on the site that we wanted or that you wanted us to do, because it could encourage more clicks. We didn't have to quibble over your placement or your size of image or anything else within reason. And so you were able to sort of navigate the site and figure out where you were intrigued by as a consumer coming in and find things in all the right places. It also meant that the merchant got the highly qualified person, but they ultimately had to close the sale. That's not something we could do. And you should also think about whether, are you the transactor? Because if you are, then a take rate's a highly logical way. If you're not in control, but you have all the responsibility, then passing it on and letting somebody else be responsible for it makes sense, but you should still be paid for that. And I think a cost per lead is a very, very rational way for you to do that. The other way you can do it is look for value-added services, particularly in some of the industrial settings. I found that to be a bit harder. The more complexity you add, the harder it becomes. I like a keep it simple, stupid approach. It's either a percentage of the transaction, a cost per lead, something very clean and straightforward, and always tied explicitly to the deliverable that somebody wants. Sorry about that. If it's that lead, if it's that buyer, great. Depth of content is really important, but in a different way than I think most people realize. I'll tell you a quick story. In the early days of Fashion Mall, we were obsessed with pretty pictures. And then we put up a alt. For those of you that didn't ever write HTML, alts were the simple text versions of the site to make sure that people without visual ability could get in, meaning that they didn't have a browser that supported images. So there was actually a time when that was the case, or they were visually impaired. What we discovered was all the pretty pictures in the world made the site look nice, but something in excess of 90% of the traffic happened through the text interface. Not because people couldn't see the pictures, but because they viewed the pictures as advertising, and they viewed the text as content. And so we ultimately, after several years, started on a mission of removing content from our site. We removed as much as we possibly could, because what we realized was our clients were our content. The brands that we represented, that we put on the site, everybody else, that was content. And the easier you made it to navigate the site, the more likely the people would end up in the place they wanted to be, and that those people that you were representing wanted them to be. So we constantly trimmed content. Yeah, I got a lot of flack for that, but it worked exceptionally well. We had a drop-down bar, we had a text listing, we had all these places where you could find anything you wanted quickly and easily. And there's something non-threatening about a text link, which allows it to be a very easy thing. And I've noticed this today with companies I work with as well. They will often assume it's all about the visuals, but it's just easier to keep it in the flow. I'm not saying you don't have those visuals. There's all kinds of content that can add value. If you don't have the traffic you need yet, obviously content marketing is a valuable way to do things. You can create all kinds of honeypots of interesting information to bring people in. But it is interesting to look at the simpler you can keep it once you have that consumer on the flow, the better. This also goes to a key reality in mobile, which is something we learned early on in the web. The fewer the clicks to get there, the higher the conversion rate. It's interesting to me how, with some rare exceptions where you can create more engagement. Josh Ellman talked about this recently, sort of how you can create more engagement by having more depth in onboarding. But in general, when I'm there and I'm navigating, I need to find something, the fewer clicks, the better, particularly on a download flow, if you're talking about doing your product through mobile. So there's a lot of old wisdom that's left over that I think people have had to relearn, which I find somewhat surprising. There's only two ways to learn, right? You can learn from your own experience, or you can learn from somebody else's. And learning from somebody else's tends to be a much cheaper way to go. So that's sort of the heart of what my view is on GMV versus revenue. Revenue is almost always going to trump it. You will see acquisitions out there. I've seen some. I spent a bunch of time looking at a company that had not yet gotten their GMV to convert to revenue, or had gotten to converting, but at a very, very modest level. You know, they had, let's call it $1 billion of GMV, but they're only making $1 million of revenue. But I actually thought there was multiple ways they could change that dynamic, and that got me pretty excited. In the end, that didn't come together. And that company did sell for a few $100 million, not on the GMV, but on the relationships they had, because they were in a market that people really are trying to get into right now. And sometimes, you know, if you can't convert it, but the buyer can, that's a great 1 + 1 = 3, because you've got all those relationships, you've got all that access, and someone else can now find a way to monetize it. You know, when the bubble burst back in the 90s, I bought about 12 companies that were very well funded, usually, you know, somewhere between $50 and $233 million. And I paid between $10,000 and $100,000 for them. And we monetized them all by just changing the metaphor. But it was interesting to watch how they had effectively focused all their energy on clicks and volume and what I would call the GMV of the day. And by a change in metaphor, we're actually able to make them into cash revenue generating businesses. Saw the moderator pop in. Maybe that means there's a question. I could read you a book. I could pull a book off the shelf and do a little masterpiece theater. Well, I have told you pretty much what I feel about GMV versus revenue. If there are questions, I'd be happy to take them. If they're not, I can give you some time back.
Hey, Ben, there's questions in the chat. If you want to go ahead and just shift over to there and read the questions off.
Okay, there is not a chat on my screen. So, oh, I had to pop up a window. Chat. Hi, Ben. How would you as a VC view using GMV for a tech business offering a marketplace system to a specific sector? Okay, I see this one question, but to be honest, I'm not quite sure I understand it. How using GMV for a tech business offering a marketplace system to a specific sector? I don't know what that means, unfortunately. Our clients own their marketplace. We take a commission on their turnover. All right, let me keep going. When do you consider that demand and supply is balanced? When both sides are happy. You know, when I come in as somebody that's seeking supply and I have enough to get what I need, then I think we're in balance. When I'm a seller and I'm a supplier of merchandise and there's enough demand that I want to stick around and use your system. You know, if you have, let's say as an example, that you have 100 suppliers and one buyer, well, you're going to lose 99 of those suppliers because the buyer's not going to visit them, and ultimately they're not going to be creating value. So both parties have to be happy. Influencing take rate and ability to monetize. So I think this would come down to how valuable what you're delivering is, and how, you know, how precious, how hard is it for them to get. If somebody's selling product, it's almost never the case that they have more demand than they need. So that's always going to create value. The margin on the product that's being sold is going to create value. If you have a high margin product, you can pay a lot more than if you have a really thin margin product, unless the order sizes are quite large. You know, if you're selling cement and you're only making $1 a pound, but you're selling 48 tons at a time, then, you know, that's a different sort of model. Might be one that would be better to sort of price on the transaction in total or on the lead. You mentioned that you don't like when entrepreneurs don't charge. How do you feel about charging during the pandemic temporarily? How about not charging temporarily to drive loyalty and adoption, the full intention of going back to charging? That's a very reasonable point. I'm not saying that there are no instances where you shouldn't charge. I mean, there's certainly a period of time when you shouldn't charge. We're in a particularly traumatic time. I'm a big believer in merit-based everything, merit-based pricing. So not charging during the pandemic would seem like a very wide statement. If your client is a grocery store chain that is literally struggling to meet inventory demand, then I'm not sure, or Walmart or Amazon, I don't think they need a break. If your clients are small restaurants, absolutely. I mean, let's face it, you're not going to maintain, first of all, it's the right thing to do. You got to help these people survive. And even if you look at it selfishly, you want to help them survive so they can be your customer over time. But it isn't just, we're not charging anybody for anything. It's look at sort of who has the ability to pay. There's an old saying about credit. Credit is both the ability to pay and the willingness. Similar thing here. There might be plenty of people that want to pay you and they can't. It's perfectly reasonable to give them an option to sort of wait. You could also defer. We did something, actually I did this my own payroll. We didn't have enough money to make all the payroll we wanted all the time. So I would just defer my payroll as an entrepreneur. I would just put it on the books. Like, okay, the company owes me this money. I didn't get paid my payroll until our IPO. There was always something else I could use that money for. So I just deferred and deferred and deferred. I think I had like 4 years of deferred payroll. So you could allow your clients to defer if you believe they'll be strong later. That's another way to not give up the revenue. Also, I think the model of pricing is really important. Even if, here's an example, and this is taken from the mobile space. One of the apps I worked with had everything free and no advertising, and they had a robust customer base. So then they added ads to the stream, and all their existing customers, a lot of them got all angry. What are you doing putting these ads in? But they looked at the cohort of people that signed up after the ads were there, and they didn't care. So what I've encouraged people to do in that environment is, if you're going to rely on advertising as an app developer, and you can see this is metaphorical, but it's relevant to what I'm talking about, just put dummy ads in the beginning. Just get people used to them being there. They're not going to complain if they're part of your system. They're going to complain if they add it. We get very entitled, all of us. We get used to what we have, and we don't want things to change. So, the same thing can be true of pricing. Even if you let it be deferred or temporarily waived, maybe your pricing is X, but for the first 3 months, 6 months, a year, they don't have to pay it, but at least they know what it will be. What if your GMV creates real value, real benefit, like positive cash flow? Well, then it's not GMV anymore. If it's creating cash flow, it's revenue. Revenue is you getting money. Cash flow to you is revenue. GMV, gross market value, is not revenue. It is the amount of things that are happening in your site, and if you're not taking part of it, right? So that's exactly the point. Real benefit of positive cash flow is revenue. So that's exactly what you want. What's your opinion on net revenue coming from GMV through an affiliate model? I mean, affiliate models are interesting. Here's another reality of sort of, I'll tell you some of the tricks of how people pitch and how people hear. Every entrepreneur wants to put the best face on their company. And so every investor knows that, and they try to listen to the words and look at the numbers and understand what they mean. Ultimately, what an investor wants to understand is, what will you as an entrepreneur make here? What will your business make? So it's the same story. Affiliate is similar in a way to just GMV in general, which is the GMV of X dollars is only material if you can monetize it, and the portion of it that you can monetize, in my opinion, in most cases. And so if that revenue is coming in through affiliates, that's great, as long as it's the part of the revenue that you are taking. Your take rate is what I'm ultimately focused on here. How do you approach calculating the right take rate on a transaction? That goes back to the point I made earlier on the higher the value the transaction is, the more take rate you can ask for, particularly when there's higher margins available. Okay, I think that is the bulk of the questions. Let me go to the other side. More questions here. Our clients are small mom and pop and personal shoppers who are struggling to feed their families, which is why we're cutting them some slack. Absolutely. Yeah, no, I think very much about what your client can afford. I think great businesses are fair to the parties involved. I do think people should price to, there's an old saying, the perfect price is when your client complains but doesn't cancel. And that sort of does define the limit of what you can price. But, treating people well on both sides of the equation is incredibly important. There's more to business than just making money. You have to make business into making money to survive, but you can do that in a very appropriate way. And this is a particularly hard time to figure out how to do it. Having said that, when your clients are fat and happy, even during these times, I don't think there's a reason to change the way things are set up for them. Thank you guys for your time. Appreciate it.